Hello, and welcome to our lecture series dealing with Chapter 14. And in Chapter 14, we're going to be talking about the cost of capital. So we're going to discuss as we go through this chapter the cost of equity capital as well as the firm's cost of debt. We're going to look at the overall cost of capital, and we're going to see how we use that overall cost of capital to actually value a company. Okay, and then we'll get into what we call flotation costs in capital budgeting projects. Okay, so we'll explain how do we include those flotation costs. So the first thing we need to really get under our belts is why the cost of capital is so important. In here, what we're really talking about is the required return versus the cost of capital. Okay. So we have hopefully we know this by now that the return that we earn on a project or an asset or whatever, again, it depends on the risk, right? So we talked in chapter 12 and chapter 13 about the market, the lessons in market history that we learned, right? Hey, if you bear risk, you're gonna be rewarded for that, and that's pretty much what we're saying here is that return that we earn on the asset, again, it's all hinges on the riskiness. Okay, so we saw back in our prequel or last semester actually to this course, introductory corporate finance, we saw about the return, right? And we had to provide if we're borrowing money from maybe a bond or issuing stock or whatever, we needed to provide those investors with a return, right? Well, that's a cost to us. Okay, so just keep that in mind as we go through. So we're worried about risk because we're trying to earn a return based on the assets that we put in place, and there's risk associated with that, right? The fact that we need to provide investors with a return is actually a cost to us, okay, as the company. So we need to take into account the cost of capital, right? And this cost of capital really provides us with an indication of how the market views the risk of our assets. So our cost of capital is nothing more than the market saying, hey, here's how risky we see your assets. Okay. So when we're able to determine what our cost of capital is, this is a great benefit to us because it allows us, and again, when I say us, I'm talking about as the company, to determine what is our required return, okay, for the capital budgeting project. We're going to have a project, right? What's our required return? Well, guess what? Our required return is based on our cost of capital. Okay, so let's look at required return, right? What are we talking about here? Well, remember, when we're talking about the required return, we're saying here that the cost of capital, the required return, and the appropriate discount rate are different phases that all refer to the opportunity cost of using capital in one way as opposed to an alternative financial market investment of the same systematic risk. Okay, so remember, chapter 13, we talked about, we defined systematic risk and unsystematic risk. And what we're saying here is that our required return consists of, hey, cost of capital, required return, and the discount rate, right? These are all just phases, and they refer to that opportunity cost, okay? So the required return is from an investor's point of view. The cost of capital, it's the same return, however, it is from the firm's point of view. So keep that in mind when we're talking about required return and cost of capital, whose perspective we're taking, right? The required return, again, is from an investor's point of view. that cost of capital, again, it's going to be the same return. However, it's from our point of view as the firm, okay? When we're looking at appropriate discount rates, the appropriate discount rate is the same return that we used in the present value calculation, okay? So, when we're talking about capital structure, remember, capital structure, this is the firm's combination of debt and equity. How much debt we're going to use, how much equity we're going to use. The capital structure decision, we're going to talk about that a little later. However, a firm's cost of capital reflects the average riskiness of all of the securities that it has issued, and hopefully those are less risky, like bonds, or more risky, common stock. Okay? All right, so let's look at the cost of capital, or the cost of equity, excuse me. And what we're going to be doing is we're going to be using what we call the dividend growth model approach. And if you remember, we talked about, we talked about the dividend growth model last semester. So we're just going to go over kind of a quick review. If I were you, I would definitely make sure you remember this, know it for class on Monday, because we're going to use this in order to help us calculate that cost of capital. Okay, so what is the dividend growth model? Well, according to the dividend growth model, we say that our P sub 0 is equal to the dividend divided by R minus G. Okay, and remember, the dividend divided by the return minus the growth rate. Okay, now we can rearrange this and we can solve for the cost of equity. Okay, so this bottom, bear with me here. There we go. So if we want to figure out the cost of capital, basically what we're going to do here is we're going to take our dividend growth model, which again should be a review, and we're going to rearrange it, and we're going to say that the return, right, is the dividend minus P sub 0 plus RG, okay? So make sure you know this coming into class on Monday. Now, basically what we're saying here with that equation is that it's equal to the dividend yield plus the growth rate, okay? Or the capital gains yield, okay? So how do we implement this approach? Well, it's not too difficult, right? We need the price, we need the latest dividend, and these are directly observed, right? We know what the price is, which is P sub 0, and we know what the last dividend is, which is D subscript 1, okay? So our growth is really going to have to be estimated. Now, how do we estimate growth? Well, typically we're going to use historical growth rates, or maybe we're going to use analyst forecasts, okay? So again, excuse me, just taking our price in the last dividend, or we take our dividend minus so to calculate that cost of capital, right, or that return, again, we're taking our dividend divided by the price plus the growth rate, okay? All right, so let's look at an example, okay? Let's suppose for a moment that we're part of a company and we expect to pay a dividend of $1.50 per share next year, okay? We estimate that there has been based on past experience, there's been a steady growth rate in the dividends of 5.1% per year, okay? The market expects that this growth rate will continue, okay? Current price of the stock is $25. What's our cost of equity? Very simple, right? We take our dividend, or our D1 divided by our P subscript 0, which is the $25, plus our growth rate equals 11.1%. So our cost of equity is 11.1%, okay? Now, we could estimate the dividend growth rate. Now, notice what we have here. We have the historical growth rates, okay? And these historical growth rates, these are fairly close. So we could reasonably, we could feel reasonably comfortable that the market will expect our dividend to grow at that 5.1%. Okay, so we know that when we're computing our cost of equity, remember, it's very important to consider what the market expects our growth rate to be, okay? Not what we know it to be internally. So we're taking our market growth rate. The market price, again, is based on market expectations, okay? This is not our private information. Remember back in chapter or last semester, we said, we think our growth rate's this. Nope. The market tells us what our growth rate is, right? It's based on how the market perceives our company and the forecasts and all that, okay? And remember, that market price is always based on market expectations, right? It's not our information. So there's another way that we can estimate the market consensus, okay? And what we need to do is we need to look at analyst forecasts, and we can take the average, okay? So keep that. Basically, the real takeaway here when we're looking at estimating the dividend growth rate is we're either looking historically, excuse me, or not historically. I apologize. We're looking at either what the market says, right? The market expectation, or we can look at analyst forecasts, right? And take the average of those. So our average growth rate, as we can see here, is 5.1%, okay? All right, so we need to look at the advantages as well as the disadvantages of the dividend growth rate model, okay? So we have advantages and disadvantages to this approach. Well, one major advantage is that it's easy to understand and it's easy to use, right? However, there's disadvantages, right? First disadvantage says the approach only works for dividend-paying firms. So if we have a firm that does not pay dividends, how are we going to calculate their cost of capital? Because it's based on price, dividends, and growth, okay? Keep in mind, too, that return, or the expected return, it's very sensitive to the estimates of the lower G, or the growth rates, okay? Okay? So if estimates in growth rate change, our return, or expected return, is very sensitive to that. Excuse me. Next disadvantage. If we look at historical growth rates, might not be a reliable predictor of future growth rates, right? We can always look back and say, okay, what did we do? Is this going to continue? Well, maybe, maybe not. So the point is that those historical growth rates, not very reliable for predicting the future. Now, risk, or another disadvantage, risk, right? It's only indirectly accounted for by the use of the price. So keep that in mind. So how else are we going to figure out this cost of capital, right? We have one way, which we already talked about, the dividend growth model. We'll go through that in class. We'll look at some examples. There's another approach we can use for the cost of equity. We can use the SML approach, right? And basically, what we're really using here is the CAPM model, okay? And, excuse me, we talked about this on Monday a little bit, just kind of a quick review. We're saying that the expected return is equal to the risk-free rate, the market risk premium, and the systematic risk of the asset, right? That beta, okay? So we're going to use all three of these, and we can find out what we can figure out what the cost of equity is using the market line approach, okay? Again, to figure out or to use the market line approach, we're just using that CAPM. Pretty simple, okay? Again, we did talk about this in class. Again, I would make sure you know this. Definitely put it on a note card, right? You're going to want to study this and know exactly what the CAPM model is. Know that it uses basically the SML approach. We'll work through some more examples in class on Monday, exactly how to calculate the cost of equity using this. But just for right now, the takeaway is really understanding this equation and knowing what it's made out of. Okay? Oh, sorry. All right, so let's just go through a quick example using the SML approach. Okay, so let's suppose that the company has an equity beta of 0.58. The current risk-free rate is 6.1%. If the expected market risk premium is 8.6, what's the cost of equity or the cost of equity capital? Pretty simple, right? Because we're using our CAPM approach, right? We're taking our risk-free return or risk-free rate plus the beta times that market risk premium, okay? So we take our 6.1, which is our current risk-free rate, plus we take our 0.58, which is the beta, times that market risk premium, okay? Now, we came up with similar numbers using both the dividend growth model and the SML approach. We should be very comfortable recognizing that our estimate's probably pretty good, okay? So again, here what we're doing is using two methods to determine, or using two approaches, and if we're getting close to the same number, we should feel good about our estimate. Now, keep in mind, the betas, these are widely available, right? We can get them go to Yahoo Finance, Google Finance, whatever, right? T-bill rates, or the rate on the long-term treasury securities. Remember, that's what we're using as our risk-free rate, okay? The expected market risk premium. Now, this is going to be a little more difficult to come up with. The reason why is because we got to figure out, what the current free risk is, what the return is, and whatnot. So it's important that we make sure that with the market risk premium, we use it consistently with the risk-free rate chosen, okay? So one of the problems is that we really don't need an expectation, but we only have past information, okay? And remember what we said about past information. It's not a very reliable predictor of future, okay? The market risk premium, again, it's going to vary through time, okay? So let me give you an example, right? In early 2000, right, Federal Reserve Chairman Alan Greenspan, He said that part of his concern with the state of the U.S. stock market, at again at that time, was the reduction in the market risk premium. Okay, Greenspan really felt that investors were either becoming less risk averse or they did not truly understand the risk they were taking by investing in a stock. So the historical average is often used as an estimate for the expected market risk premium. Okay, so keep that in mind. So let's look at just like we talked about the advantages and disadvantages of the dividend growth model, there are advantages and disadvantages of using the SML approach. Okay. First, the advantage, well, the approach is explicitly adjusted for risk, right? We can adjust for risk in a fashion that is consistent with capital market history. Okay, it's one. Second advantage is that it is capable or it's applicable to all publicly traded stock. We don't use dividends, right? So if we have a company that doesn't pay dividends, well, guess what? We can use the SML model or the SML approach. Okay. However, there is a disadvantage, and the main disadvantage is that the past is not a perfect predictor of the future, right? Both the beta and the market risk premium are going to vary through time. So that's the main disadvantage of this method, okay? So let's look at quickly another example. Sorry. There we go. Let's look at another example of the cost of equity, okay? Suppose that our company has a beta 1.5, market risk premium is expected to be 9%, and the current risk-free rate is 6%, okay? So we've used an analyst estimate to determine that the market believes our dividends are going to grow at 6% per year, and our last dividend was $2. All we need now is our current stock price. Well, our current stock price is $15.65. What's the cost of equity, right? Well, using the SML model, we see it's 19.5%. Using the dividend growth model, we see that it's 19.55%. So, being that we use two different methods to calculate what our cost of equity is, we should feel pretty confident that that's our cost of equity. Okay, so before we move on to our next video, I just kind of want to review really important some of the things you should know coming into class. Right, you should know what the cost of equity is. Right, you should know that we can either use the dividend growth model or we can use CAPM to determine that cost of equity. Okay, you should know the dividend growth model. Again, quick review of what we talked about last semester. You should know the CAPM model. Okay, you should also know advantages and disadvantages of both dividend growth model and the SML model. Okay, so I tell you what I'm going to do. There's going to be, for those of you guys that actually watch the video and pay attention, there's going to be a pop quiz. So I guess it's really not a pop quiz, is it? Here's going to be your questions from this video. Question number 1 is going to be, what are the two acceptable methods to determine the cost of equity? Now, if you write down these two answers, you got the right answer. Okay? The next question is going to be, what is the advantage of the dividend growth model? Well, it's easy to understand. Okay? Make sure you know what the disadvantages are, but I won't ask you those on our quiz. Okay? And then you should know, again, you should know you should know at least one advantage of the CAPM or the SML model, okay? And one of those answers will suffice. All right, so again, pop quiz on Monday. As soon as you come in, you already know or you already know the questions, you already know the answers, okay? And this is going to be for um, uh, to reward you guys for actually watching the videos, okay? So if you watch the video and you don't tell anybody, or don't tell anybody, they got to watch it on their own, all right? All right, so tune back in for our next video where we look at the cost of debt, okay? And we're going to look at preferred stock as well. So tune back in for that one.